All right. Okay, so hi everyone. I hope you're doing well, and I must say that today is a pleasure to have Andrea Appeddu with us at BQuant. Um, Andrea has a very interesting career, I think, and I thought that was a great opportunity for him to tell us uh, a lot about it. Good career in finance, quantitative finance, perhaps sometimes more on the research side, but very interesting career. He will tell us more about it, but in a second. And Andrea and I met back in what 2010, I believe, when we were at Moody's Analytics. Yeah, uh, when we did also a bit of modeling on market risk exposures and market projections of risk drivers. But anyway, we'll discuss that in detail in a few minutes. All right, Andrea. We like, I mean, we like all sorts of profiles, but we like your profile especially because it's very often the case that people ask us to how do we get into this field, how do we get into quantitative finance, UK, US, etc. And many people think that this is dominated, and to some extent that is true. This is dominated by purely quantitative profiles, people coming from data science, from math, from physics, whatever.
Mm.
But there is also a number of people coming from economics that have successfully, let's say, adapted to the environment, no? And that is Andrea's case,
Mm.
because Andrea has a bachelor's degree, la licenciatura in economics, a Università di Cagliari, right? And then you decided to go for the masters in finance, well, in economics and finance at Warwick Business School, right? So how was that? How did you come to that decision?
Okay, well, thank you first of all, because it's a great pleasure for me to be here, of course. And so it's a great question because um, I would say that we have a we are very close in age, and I think back in the days, because I know about your path,
I don't know
it
what you
wasn't
mean.
easy.
I'm 32 now, so I don't know what you mean.
It was it was right. It wasn't easy, right, to venture abroad because
Yep,
trivially, like in the mid 2000s, right, like there was no fast internet almost anywhere,
absolutely.
right? Like it would take ages, to venture, and websites of big education centers in the UK and the US, where they were not just up to scratch, like where everything is available on the internet today, right? So we're talking really about another world. So for
Yes.
me, let me tell you, I was a bit lucky. I always think there is a bit of luck in everything,
Mm-hmm.
because we had actually an econometric instructor in Cagliari, who used to teach at Warwick,
Oh,
and yeah, and so she thought that I could go study there, and so she recommended for me to go study pure economics. I think it was 2004 or
mm-hmm.
2005, but
Five.
basically, um, I I come from a quite modest family, so I basically I was looking for a scholarship.
Right.
So the scholarship only became available in 2006, and that's how I went to Warwick in 2006. But in terms of why studying economics,
Oh, so you
financial
had to wait
economics,
till 2006 to enroll in.
correct,
All right.
correct, correct. And for me, I would say that because I studied mostly, I would say growth stuff at university. I think it was the case in many places, right? I think
Mm.
growth economics
Yeah. Yeah.
and was pretty mainstream, I would say, in the early
Yes.
2000s. I don't know if you agree.
Yeah. Yeah.
Um,
Macroeconomics, growth models, solo. Yes.
exactly, it was very mainstream, right? Relative to nowadays, for example,
Yeah.
right?
Yeah.
And for me, actually, I remember that I got very much into macroeconomics after reading the graduate book in I think it was in international macroeconomics by Maurice Obstfeld and Ken Rogoff. It was this huge book.
Yes.
Yeah, it was this huge book where there was formalization of key concepts like stochastic discount factors. And that
And
for me was
so
really what
this
got
is
me.
yeah, this is, we can say, mathematical economics, right? Because and you read that before going to the masters.
Yes.
Because yeah, I mean, yes, you don't know Andrea obviously as well as I do on a personal level, but he's an avid reader. He didn't finally go for the PhD, but I always told him that he could very well qualify for that. He was always reading papers and stuff, and we were discussing. Remember, we were discussing those papers. We would get out of work earlier and go to these pubs around the St.
Yeah.
John's area and have a beer and discuss papers. So that was our
It's true.
nerdy our nerdy moments.
No, it's true. It's which is I think it's actually I think it's the beauty of, I would say, big cities even nowadays, right? Which is when you live, of course, in a big city like London, especially in those years, is an opportunity to meet people, who are who have interest aligned to yours.
Right.
So it's I think
There are
that's
more people, more qualified people. You met people with interest similar to yours. You meet people both on academia that have exposure to the industry and in the industry that have had exposure to academia. So, all right. So basically, your motivation to go for the master's program was to dive deeper into economics to get a
yes.
more solid education.
Yes, and particularly again, like I generally remember, the fact that basically, you could kind of formally derive basically, contingent claim pricing from basic utility function. And I remember this professor at Warwick. I don't remember his name, unfortunately. I remember he was Greek, and he had studied at LSE. And I remember the first day of the master, he said, if you are here to study finance and think that it's similar to macroeconomics, you are wrong, because finance is all about microeconomics, because it's all about choice under uncertainty, it's all about constraints, and it's all about risks and rewards. So it is, and I
So
mean,
your first day, you were a bit like, what the hell is this?
see,
I'm
but
in the
then
wrong place. No? All right.
no, it's true, because as you remember, right? Like the point is that there was this kind of separation between microeconomics and macroeconomics.
Yeah.
But and then I guess in particularly in the 1990s, there was this effort by all these big American economists. I remember a few names. I remember Mike Woodford, for example, to microfound macroeconomics. And so,
Macroeconomics. Yeah.
and I think that was the big change, because I think it became quite much more formal as discipline, and but also much more interesting, because and I think that's what saved, if you like, that approach,
Yeah.
because you said earlier that a lot of quantitative finance roles are are dominated by people who studied mathematics or physics.
No.
I think
Yeah. So
you need a bit of.
I like to differentiate always, sort of to make these two strands of finance. So say people when you say when you people say quantitative finance, people normally what they're thinking is stochastic pricing.
Bra.
With with stochastic option pricing models, continuous time, black and Scholes, blah blah blah. Black and Scholes apply to a variety of things, right? But there is also, and it is true that was perhaps the dominating finance back in the 90s, 80s, 90s, perhaps early 2000s, and that type of models, true, was most perhaps more based on microeconomics than macroeconomics, maybe. But then within time, people have managed to, right, to involve all of the disciplines together, because there are links
Exactly.
macro to finance,
I
micro to
think
finance.
so.
So yeah,
I think it's much less sectarian today than it was like
yeah,
say 20 or 30 years ago, where there was, more like separation walls.
yeah,
And I think the big difference, right, is that, quantitative finance as, pricing, as you mentioned, which are basically, all the guys who start with, a diffusion equation when they start moving, modeling something under the physical or historical measure. That's the world that, it's the world of mathematician. But when you actually look at who brought these techniques into the academic world first, these guys were economists to start with.
yeah,
Fisher Black, and Myron Scholes
yes,
and all these
yeah,
people, were actually people with a deep understanding of economics,
yes, yes.
and
And I
that.
remember when we were at Moody's, because I remember we having this sort of clash in a way with the people from the group, from the KMV group. Remember the KMV stood for Merton Vasicek. What was the other guy? K.
I don't remember,
Anyway,
but yeah,
K.
MMV
So
definitely Merton.
right,
Yeah,
there was this KMV group that they were doing mostly what corporate consulting, financial analytics on
yeah,
corporates, yeah,
corporate default modeling and all this
default
stuff. Yeah.
modeling, right, corporate default modeling, and they were the models that they used were mostly based on this Merton Scholes, Black and Scholes approach, and they didn't involve, and they were using those models to model the interest rate curve, if you remember, right? And I remember going to a couple of conferences where we spoke that they had this approach using those type of models with very little macro, if any macro at all, and we were heavily linking the interest rate curves with macroeconomic variables. And sometimes we spoke in the conferences right after them, and we would start talking about bringing macro into those models and sort of challenging their approach. So that was fun. That was fun. Anyway, that was to make the point that macro also came into the picture later on quantitative finance.
Yeah,
Right.
and so I think again there was no difference initially, right? Because the things basically, whoever does, for example, nowadays, whoever publishes on, say, illiquid asset pricing, or heavily model dependent arbitrage models, all this stuff, ultimately, I think the father of all this is Canaro, right?
Yeah.
And there is
Aldebre.
only one. There is, they are all, all these kids that all have the same parent, and I think then there were like possibly in the 80s a separation, and in the 90s, and then I think in the 2000s again, I think things have started slowly converging back. And I don't know, but for example, if you read the work of most of Donald Duffy's
Yeah. Yeah.
work, you would say, yeah, I mean, it's definitely a financial engineer, more than an economist, but he uses a lot of economic reasoning in his work. So I to be honest with you, I think that it's important to know both, and
Right.
and I think yeah,
Exactly. There is still our message is usually there is still room, plenty of room for economists in quantitative finance. Let's say. All right. And
absolutely.
so basically, right, your motivation for the masters was to get a more solid foundation to go into the market, and then also get a foot in the UK, in the Anglo-Saxon market. Um, so from there, well, I guess I would be happy to talk about our stay at Moody's, but I think it's perhaps less related to. But anyway, perhaps we can go back to that. later on. But at the moment, perhaps I think we can jump to your stay at Millennium Global. So Andrea spent a number of years there um, on the modeling systemic strategies, systemic modeling of FX, right? At Millennium Global. Perhaps you can tell us a bit about your work.
Yeah,
And then,
sure. So Millennium Global was and still is a kind of a currency management house, and it has no link with Millennium Partners, which is one of the large hedge funds in the world. It's just an independent currency management house, and back then they had this systematic team, and which was being built by the same guy who had basically introduced a lot of the systematic stuff at the Barclays Global Investors (BGI)
mm-hmm.
in the 1990s before they were bought by BlackRock.
Okay.
Because as you might remember, basically Barclays sold Barclays Global Investor, which was its asset management arm, to BlackRock, in the aftermath of the
Yeah.
great financial crisis. But basically, the guy there at Millennium Global who was, building up the systematic framework came from there, and so basically it was so just like I would say that there are it was a quantitative role, but without being a financial engineering world
Right.
role,
So
meaning
wait,
that at the
wait a second. When you say that you were managing currencies, what does that mean? Were you managing the currency trades for companies, or what sort of what sort of work, what sort of exposure did they have?
yes, I think the clients back then were mostly pension funds.
Uh huh.
So
Interesting.
the firm would basically sell currency overlay services, which means basically, these big pension funds, they often have internal as well as external managers for their assets.
Uh-huh.
And then, within the external manager mandates, they often actually manage currency risk apart.
Yeah.
So
Yeah.
let me give you an example. They would say they would give I don't know, a fixed income, global fixed income mandate to say a traditional asset manager, but then the currency risk would be managed by another manager,
Right.
and yeah, that was the business model, and yeah.
Mm-hmm. All right. All right. Good. Good. And well, I don't know if you remember. So pension funds and some other type of client. Anything that you can perhaps some details on
No,
those?
pension funds were really. I would say most of the clients were pension funds,
European
and
pension funds or UK?
no, I remember there was actually I remember there were two big American ones.
Ah, yeah. All right.
Pension funds, American pension funds, and yeah, I think
All
pension
right.
funds was generally possibly
The largest
the
client.
only client, the
The
only
only
type of
client.
client.
All right. Okay. And what sort of what would be the day to day work? What sort of models or what sort of strategies would you analyze or develop?
So yeah, so the reason why I mentioned earlier about the Barclays Global Investors background of my manager back then is that Barclays Global Investors was actually the first kind of asset manager to really introduce factor modeling
Mm-hmm.
in the practitioner world, and it was there were basically the two guys from there. It was Rich Greenwald and Ronnie Khan. I remember their names, and so it was a lot of multi-factor modeling.
Uh huh.
So uh, you know
Okay.
basically all derivation from the APT world, the kind of I would say
That
the thing I
APT, for those that maybe not in the literature, arbitrage pricing theory, right?
yes, correct, right, that they developed in the early
That's where
80s, if I'm
originally
not
the factors come from, right?
correct. And all this, which going back to basically stochastic discount factor, and I remember back then I used to read a lot stuff by. I remember there was this great financial economist. His name was Craig Burnside. All these people working basically on on this kind of models, which mainly came from the equity world.
Uh-huh.
So and I remember that one thing I really enjoyed kind of doing was that in the equity world there's always a risk-free asset, right? And in the currency world there's no such risk-free
Right.
asset.
That's interesting.
Y-
Yeah.
and so I remember it got me thinking about the role, for example, of numeraires. Again, I think numeraires can, even there, can be understood, you know possibly better by an economist who studied,
Yeah.
that you can normalize, uh, you can write your utility function in terms of 1 unit of, I don't know, bread consumption.
And express everything else in terms
On
of that. Yeah.
exactly. Of course, financial engineers do the same. But I would say that on a practical level, I think, yeah, there's definitely a lot of insights which are really valuable in the microeconomic world
Yeah.
again. So a lot of stuff that I did was basically of,
Multi-factor modeling. Right.
yeah, so a lot of work on covariance matrices, factorization of covariance matrices. So a lot of work, if you like, on the cross-sectional dimension of the data, and
And what was
and then
the objective, sort of the final goal, let's
the
say?
final goal was to have a model which would run every day to decide the trades in our portfolio.
Mm-hmm.
So we would buy and sell currencies. In particular, we would buy and sell currency forwards, short-term currency forwards, and yeah, and it's so everything up to the execution point was
Right.
automated, and then the execution was actually the only thing which was not automated.
Okay.
Uh, so the execution was done, by a person.
Right.
Um, so we would send the trade tickets. So the model would spit out some trade tickets, and we then would, physically email the trade tickets to the execution trader,
Mm-hmm.
who would then, of course, go for
The
best
trader
pricing.
was at your firm as well, or that was outside your firm, and then the trader would decide where to send the orders, or.
No, yeah, I think it's the usual price discovery mechanism. So basically, you ask for
Mm-hmm.
quotes to dealers,
Right.
and then you decide.
Okay. So.
It was not electronic trading, so
Mm-hmm.
it was literally,
Over,
give me the price for
over the
this, and
phone.
then the
Yeah.
execute.
So.
Yeah, or
And
Bloomberg.
oh well,
Bloomberg,
yeah,
I would say that was.
yeah, yeah. So but it was ultimately everything was guided towards hedging currency risk, or there was also some currency trading per se, just to make money out of currency trading, or it was just hedging risk.
Yeah, there were. I would say a bit of both, actually. A bit of both. So it would depend on, like, the model was one, but then depending on the investment mandate agreement,
Mm-hmm.
the models would take position differently for different clients. So the view, say, on
So let's say you have one
The,
model and that you calibrate it differently for different clients or different goals.
yes, correct.
All right. And did you just perhaps one final question before we move to your
Of
city,
course.
your work at City? Did you have to? Because Andrea, you moved there right after Moody's Analytics, I believe. No. So and we didn't do much work on currency risk and
No.
Moody's, if I remember correctly. So did you find it hard the move to the change at when you landed at Millenium Global? Did you how did you get up to date
Mm.
with that stuff? Were you just books or papers, or how did you?
Yeah, no, to be honest, I didn't really struggle because I always kind of was always a bit of a, self-starter. So I never kind of, you know, uh, you know, I always wanted to read things first, basically,
Mm-hmm.
firsthand,
Right.
and so not really actually. I
Okay.
would say I found a way to try and add value, which was I'm sure very different, uh, because ultimately I wanted to make relevant what I was, where I
Yeah.
felt my interests and my passions
Yeah, I remember you
were.
did a lot of resourcing new ideas for the modeling, and yeah.
Yeah, I remember, and I remember, for example, doing studying a lot of, studying a lot of regime change detection and all
Uh-huh.
these kind of things. Especially on a kind of, if you like, multidimensional object, like like a covariance matrix and all these kind of things. Uh, but these things, I would say, unless you really kind of, I would say, these things are never really taught, right? Like
Yeah,
unless you do
exactly.
really kind of some research, you
Yeah.
say that you do a PhD in regime detection, regime change detection techniques. I think there is generally, that these are things that are not mainstream, right?
No, no. All right.
And so I think, ultimately, and I think a great, that's a great change relative to the 2000s, particularly to the first half of the 2000s, is that all these things nowadays are available on the internet, right? And
Absolutely, absolutely. Back then,
and
we would have to go to books and stuff, or yeah, or papers. Yeah.
you had, yeah, absolutely. It wasn't easy, not to speak about the fact that
I mean, there were papers on the internet, obviously, but back in the time, remember, not all of the academics or practitioners would upload their papers on the internet. They would upload some of them, some of their work. Normally, by the time they uploaded it, it was fairly out of date in some instances,
yes.
and all the papers, all the
Uh,
content was locked or under subscription. So it wasn't as
it's
easy
a
as today.
very
Yeah,
good
yeah,
It's a very good point, actually, because I remember, for example, there were some practitioner journals, like the Journal of Portfolio Management, or the Journal of Fixed Income. Said these are kind of
yeah.
practitioner journals,
And just
which
to
would be very.
just to give some context, these are the Journal of Portfolio Management, Journal of Risk, etc. These are the type of journals where also very let's say well-known practitioners publish on some regular basis, like Clifford Asness and people like that. They publish in those journals. Sorry, go ahead.
No, absolutely, and they were very strict on copyright, right? Much more, say, than the American Economic Review or the Quarterly Journal of Economics. Even though I would say you agree with me that the scientific weights will
Yeah,
be quite different, right?
yeah,
And nonetheless, even it was very different. Not to speak about even only say 10 or 12 years ago. no, it would, there would be almost no codes on the internet. They wouldn't, share their codes
Exactly. No.
to reproduce the results.
No.
And
Not at all.
it was, so they were, a bit, it was a bit more challenging, if you like, from this point of view to kind of
Self-learning. Yeah.
yes, it would be, you would have, you would have to get your hands dirty, basically.
All right. Okay. So speaking about your time at Citigroup, so I think you spent what for like 4 years or something at Millenium Global, and then you moved to Citigroup. We'll perhaps discuss a bit about how did you make those moves, how did you navigate the job market in that regard. But I mean, you've been at this point what 8 years at Citigroup, something like that. So
Yeah, 8 years,
it's
exactly
a
eight
it's a
years.
fairly long span, and maybe you've done different stuff along the way. But if you can tell us a bit more about the I don't know the type of work that you did or that you do at City that you found more interesting throughout those years.
Yeah, the first thing I want to say is that actually I didn't apply for the job that I eventually got at City because I thought I had applied for another role. So I think, uh, I remember it was summertime and possibly I was tired. And, I actually, I know for a fact that, what I applied for was not what I wanted to apply for. So again, you see that there is a lot of uncertainty in decision making that is hard to formalize, right? And so that happened again quite randomly, I would say. So back then there was this guy was the global head of interest rate strategy at Citi, who was looking for someone who basically understood what the Markov chain was, and and I didn't know why he was interested in the first place. But basically, I remember going to this interview with this guy who's now, is now since he's since moved to Citadel and is doing very well there.
Uh-huh.
But basically, I remember having very very strange interview. He asked me, "Do you know what is this?" And I said, "Yeah." And then the next question would be, "And do you know what is this?" So, and I
Yeah.
said yes because I generally knew his idea was basically to try and understand a bit how central banks think. So the things he was asking me, it was things that
So
particularly.
was that related to the regime switching stuff that you were studying back in Millennium?
Yeah, but not only. But I remember there was. So we are talking basically about, he wanted basically someone who could interpret what, central bank research staff was doing at the Fed, at the ECB, at the BOE, and the Bank of Japan. So these guys, of course, they were like, you know, properly, formally trained economists, and they were, um, we always have to, I think, put things in a context, and we're talking about, I think, 2016, and basically we were in a regime of very low inflation in developed economies. And so basically, there was all this debate about, um, if inflation would ever pick up again. And so there was a lot of revival of the work, for example, by Stock and Watson on trend versus cycle, no?
Yeah.
Or, all this stuff. So he wanted someone who was familiar with that with that literature. So that's how I got a job,
So he
basically.
basically wanted someone with enough background on the methods that would apply to central banking and their effect on interest rates. Yeah. But the ultimate goal
Perfect.
was interest rates. Yeah.
Yeah. The ultimate goal, basically, well, that's the thing. Initially, the goal would be to understand what central banks are, which lenses
Yeah,
are
yeah,
central banks using to interpret what's happening, right?
yeah.
And now, speaking about, I challenge, of course, a financial engineer to try and follow back then there was Draghi at the ECB, and there was Yellen at the Fed,
Hmm.
and and try, for example, and follow the way their press conferences
No.
without knowing about concepts like trend inflation, or R star and real equilibrium rates, or
Yeah.
or the debate around QE, because that again, every I think always it's important to put things into context. Back then, central banks were doing QE in practically everywhere. And so, the literature on the term premium compression in on sovereign curves, I think that was, there were great papers in those years. I remember there was a paper by two LSE scholars on, for example, preferred habitat investors.
Hmm.
Like why basically, why some investors, only invest in a given part of the curve, which is not what you would do necessarily if you were optimizing a, risk maximization objective. Risk minimization objective. And so there was this, all this stuff, and it was super interesting, because basically central bankers ultimately wanted to, like, they were really wanted to know, when, how to frame monetary policy, because, ultimately those years, we got to QE because of the inability of interest rate cuts to
Yeah.
basically revive inflation expectations in advanced economies. So,
Yeah,
these
the
topics were.
ineffective, because of the ineffectiveness of orthodox monetary policy to get
Exactly.
the economy circulating again. Yeah.
Absolutely. And I think, all these, a lot of those decisions were actually, were results of basically of the frustration that the central bankers felt about their mandate. The fact that that and so, like, there was a lot of
So basically,
uh,
the Citigroup people perhaps wanted someone who could help them understand this new framework of monetary policy and
yeah, yeah, yeah,
and model interest rates with new methods or something.
yeah, which were, to be honest, those methods were not new.
No, no, yeah.
Like, we're not new at, it's the fact that they were being used
Mm,
in a with a very practical goal
right.
of basically you know how to revive inflation, because it wasn't until the pandemic, basically in
Exactly, I was going to
2020,
say.
that the problem was solved, by something else.
Well, temporarily, as Powell would say.
Temporary. And
I mean,
so,
this can give all sorts of, I don't know, conspiranoics and stuff about maybe they engineered the pandemics, among other things, to revive inflation. How about that? Anyway, so what about the if you can tell people a bit more about your daily work at Citi, perhaps I don't know, at the beginning or now, what sort of models you normally use, or what sort of outputs people seek to obtain.
no, I did this basically for the first uh, 2.5 years slash 3 years, and then basically the person who hired me left,
Mm.
And so my job changed a lot because, at that point, I started basically kind of becoming much more of a kind of more traditional sell-side research analyst. So about writing, and very little time to put models together. And I would say nowadays I don't use any models in my day-to-day. But I guess the, having spent many years doing that, I think the framework is always kind of somewhere in my head.
Yeah.
And so now it's more about um, it's more about I look mostly at money markets in the eurozone, and I look at swap spreads.
Mm-hmm.
I look at swap curves, and that I would say is the things I look at most. So I don't really use models, but
Okay. Okay.
uh,
So if I remember, back in the time, interest rates or swap curves were one of the objects that we used to model Moody's Analytics for. Well, many of the clients back then, they would be capital markets departments at different institutions, or banks, or hedge funds and the like, with exposure on interest rates, or derivatives of interest rates, and they would ask us to model those curves as a function of macroeconomic
mm,
scenarios. Remember that, because they would also want to stress the curves, be it for stressing their portfolios on the different assumptions, or because of regulatory purposes, whatever. But so what I mean is, where I'm going is, interest rate curves as a function of macroeconomic drivers. And the formal models back in the time, they would be relatively simple models, um, factor models. Remember, where we would link, we would use principal components decomposition to relate each of the interest rate tenors to the macro drivers, right? And then linear estimation, da da da. So, what sort of so the two questions, I guess. What sort of models, when you used models, what sort of models would you have on your day-to-day basis? And what was the output? So in our work at Moody's, the output would be projections in time, uh, 3 years, 5 years, whatever, of interest rates based on macro scenarios. That would be one type of output. Another type of output would be, I don't know, in probabilistic terms, the probability that this part of the curve is above X is Y%, whatever. So what sort of output would the people at Citi need from your models, and what type of models?
I give you an example.
Hmm.
So I did a lot on, for example, term premium estimation. And for example, in most term premium models are kind of from if you like an econometric point of view, are really VAR models, so vector autoregressions.
All right.
Okay, so that would be the, if you like, the econometric toolkit.
Okay.
In terms of output, you would be basically decomposing the most liquid tenors on a given curve into interest rate expectations,
Mm-hmm.
term premia, and pricing errors. So that
Yeah.
would be kind of the output. And in those days, it was important to understand, particularly what central banks would be seeing in terms of the impact of quantitative easing on interest rate expectations and term premia, because to see if they were kind of having an impact,
Yeah. Okay.
their
So
policies.
so if I'm not mistaken, that sounds a lot like interest expectations. Sounds a lot like if you decompose the curve in two principal components, level and slope, right? So interest expectations sound a lot like the level, the first factor of the level, and then term premium is the slope of the curve in a way. It's an approximation, right? Could that be
Yeah,
understood
yeah.
that way? Yeah.
I would say, yeah, I would even go further, and I would say that, given that we spoke about trends and cycles, I would say that, if you decompose, even expose, because then, of course, in term premium, there are in term premium models, all these, terms that we spoke about, expectations versus premium, have, an observable component, meaning, at the very end, the interest, basically the interest rate expectation is basically the average funding cost of keeping a given position, fixed income position over time, and the term premium is basically is the return on that position. So I would say that in terms of interest rate expectations, identify basically with the most persistent component of
Okay.
persistent component of interest rates, while term premium identify with the most cyclical component
Yeah. Yeah. Exactly.
of the curve. Yeah.
And did you so what was the immediate use of that modeling? Would you send the output of that modeling to some department that then would use that to trade or something, or what would be the
No, 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 no. That we would ultimately write about it. So we
right?
would publish those things, and then because that was the way it was used. Yeah.
Okay, and the so and were there any specific departments that were using your research directly
No,
or
because it's
clients?
yeah, clients, yes, because ultimately research in investment banks is a client-facing role. So basically, is independent from the other parts
Yeah.
of the bank.
Okay.
So ultimately you are working for the clients. You're not working for the other parts
Of the
of the
bank.
bank. So it would be mostly, we would do things that uh, where we would see demand from clients. So that was, if you like, our objective function
Yeah.
was to keep a certain level of engagement with our clients.
Right. And
Yeah.
what were the type of clients back then? Who would be the demanding your?
Well, back then, I would say mostly hedge funds and real money as well. Real money is meaning basically traditional asset
Yeah.
managers. The big asset managers. Yeah.
Yeah, because at the end of the day, they have perhaps hedge funds more on the quantitative side and traditional asset managers more on the qualitative side, but they ultimately they can use that type of analysis, forecast, interpretation of interest rate curves, right, in order to I don't know overweight some classes over another type of classes or overweight some geographies versus others, so sort of to make let's say high level strategic decisions, I guess. They can use
Yeah,
it.
yeah, and I remember I used to do a lot of training as well. So I would literally they would come to me and say, we have something similar. Can we go through it together to see. So there was a lot of that back in the days.
Okay, okay, okay. That's great. That's great. And so, as a final, perhaps discussion, I was planning touching on the topic of right job market and careers. We were just discussing. Perhaps this can serve as a to set the frame, but. Just before we introduced the call, Andrea and I were discussing that he spent well what 10 years or something in London with
Yeah, I mean, in the UK, I spent 17 years,
17 years,
and
yeah,
in London, yeah, like 15
including
and
the
a
masters and
half.
everything, yeah.
Yeah.
And then he recently moved to a few months back to Italy with his family in
Correct.
one of those moves, right? So he moved out of the city, out of the big city, into a more family-friendly ecosystem, I would say.
Yes, yes. No,
All right,
it's a good definition.
all right. Because I remember back in the time, well, I remember many people at Moody's and other places, many other places, right, commuting into London in the morning and out of London in the evening, but people making like 2 hour, 1 hour and a half commutes and things like that. People with family mostly, because obviously, I mean, when you're single, you can live in the city, try to make your way, da da da. But I mean, once you have some structure, yeah, then the logistics and everything become
S- s-
a bit heavy in
It's
London,
true.
in the city. Um, all right. So just in general terms, how did you navigate? How did you find these jobs, Millennium, and then you told us about City a little bit. How did you navigate the market? What recommendations would you have for people trying to get in this field in
Mm.
London?
But I would say, I mean,
I mean, it is
it
true that you
seems.
search for those jobs in a different time. Nowadays, maybe the way to navigate the market is a bit different, but I don't know. If you tell us about your experience and perhaps your experience
But I
with.
would say that today, my feeling is that the most important platform is LinkedIn,
Yeah, that I hear
and
also.
yeah, that's because basically you have access. So my recommendation would be to keep your LinkedIn profile as
Updated.
accurate as you can,
Yeah.
as accurate as you can.
Mhm.
Um, I in terms of I you know big banks and large asset managers, I think they still mainly hire through either graduate programs or when they have specific openings, those openings are on their websites.
Yeah.
So that I don't think has changed. What has changed over the last, I would say, 7, 8 years, possibly, is the with these multi-strategy funds, the likes, of Citadel, of the one we were discussing before.
Yeah.
These big firms. My impression is that they mostly delegated either to what they call business developers.
Yeah.
Business developers, despite the name, are actually like kind of internal headhunters.
Yeah.
So they
Exactly.
are headhunters based, inside the fund. Okay, and whenever someone in the firm needs someone, they ask these guys basically to look for the right profile.
Yeah.
And so these are and I think these are the guys possibly who are also also most rely on headhunters still.
Yeah, and they where would they look? These business developers people they will look, as you say, in graduate programs, but also for relatively more senior roles. Would they look in other companies, other institutions in the city, or?
Yeah, well, I know, I know they always try and have a kind of a landscape of who does what, at least in major banks,
Yeah,
and then they would use the headhunters as well, uh,
right.
often to help them out.
Right, because they have a database of people, and that's why it's important.
Yes, yes, yes.
Every now and then, I get these emails or these messages in LinkedIn by headhunters asking me to give them my data so that they can put me in their databases. So obviously, I'm not in that situation, but for many of you, perhaps it's recommendable to to give them your data so that you can be in several databases and more easily found when people are looking for profiles. Okay.
Yeah.
Okay. And what sort of what do you think? What sort of profiles are more in demand in the field that you've spent time at, or by talking to other people, what sort of profiles are more in demand, do you think, now and perhaps in the coming years? This is
Uh,
a very general question, I know, but
mm, no, to be honest, I don't have a clear view on this. I don't have a clear view. Um, I think ultimately, what I know, that has changed, that I can see, is that a lot of people with interest to do research in financial services, in particularly in the investment world, you know, back in I would say until again 7-8 years ago, their only place was big banks. Like
mm-hmm.
banks were the only. Today has changed completely.
Yeah,
These multi-strategy funds have armies of researchers. There is a key difference though, that unlike in the bank where researchers work together and often serve
yeah, that's it.
the same client. These guys work on desks which are more or less competing against each other.
Yeah,
And
and
so I think
each research team is doing the work that that particular team needs, and that may be
exactly
unrelated
that.
to other teams. Yeah.
Exactly that. So I think that's what has made it difficult to understand what is in high demand, because
Yeah,
most of these, as you said, a specific PM portfolio manager can have very different requirements in terms of
mm-hmm.
who they want to work for them, and
Right,
so I think that I think is the big change that has made it difficult to understand. Yeah.
right. But okay, but what I find interesting in that is that the hedge funds, well, there are two aspects here. One is hedge funds are still, well, hedge fund and some other type of funds as well. They're still uh, spending, uh, making large efforts in developing strategies and analysis, right? It's not all about just selling products. They're still doing a lot of, right, on active strategy. So that's important. And then the second aspect is, um, that it's not all about trading, yeah, and that sort of stuff. It's also about, there's a lot of roles on researching, which is very important as well.
I would say that there are. I'm tempted to say that there are more opportunities today for research-oriented people than there've ever been.
Right. Okay, and that's very good. That's very good. And so, what would be the, well, both at Citi or one of those clients that you may know, what are the typical career paths? You start out as a, yeah, I know, as a junior associate, summer associate, whatever, but then you will start out as an analyst or whatever, and then what is the ladder like? How do you grow? What is the typical path?
But I think it always depends, because there are people who always stay in research,
Yeah,
while others kind of start as researchers and then ultimately they want to trade.
yeah.
So they want to become portfolio
Portfolio
managers.
managers.
So
And then from portfolio managers, what would be the next chief investment officers level or what?
yeah, you become I think you partner of the fund
Right.
and all of these things. Yeah.
And how do they measure? Just a very final question, maybe, but how do they measure the? So obviously, the output of a portfolio manager or a trader is very easily quantifiable or measurable if you want, right?
Mm.
So see where I'm going. So, but how do they measure the quality, the output of a researcher? Because
It's a super no, it's a super interesting question, and I think that particularly when you work in a for a portfolio manager on an investment desk, I think ultimately you know it's it's up it's at the PM's discretion to value you,
right,
meaning that ultimately it's yeah, they evaluate the contribution to the investment process,
Right? Or yeah,
but not
whose
necessarily.
research, whose strategies get put in place in production, or whose not? Maybe I don't know.
Yeah, yeah. So ultimately, I think it's a trust relationship.
Yeah,
So if the PM starts following what that particular researcher says, that means that researcher
was
is
valuable.
held in
Yeah,
is held in yeah. Uh, so it's very, I would say it varies from PM to PM.
yeah. Okay, okay. That's pretty good. That's pretty good. So I don't know. I just wanted to wrap this up. I think we've you've given us enough material and information and great quality. So I'm very grateful for that, Andrea. And but I don't know if you have some final words, some perhaps wrap up recommendations on, I don't know, careers or interests, or where in the job market things are going, or I don't know, some final thoughts. And if not, you can just send them to me in
No,
writing, and I'll.
no, no, I would say that, today I think there are a lot of more freely available resources than ever before. So, I think there are generally no excuses not to know things
Yeah.
relative 2 years ago. So I think the only thing is, ultimately it's a, as I would say a lot of things in life, it's about how much effort you want to put in to achieve something. So
Mm-hmm.
you know, yeah, I would say, keep studying, keep investing in your
In
skill set.
knowledge, yeah, in
Yep.
skills and knowledge, absolutely, absolutely. Very good, Andrea. So it's been great seeing you again, and a pleasure talking to you, my friend. So I hope you just keep doing great, and wish the best for your family.
Thank you. Thank you. Thank you, Jose.
All right.